Hello guys, my name is Ivan and welcome to Magnet Trade. Today's video topic is support and resistance levels. Let's hop into the video.
Support and resistance are levels that reflect collective human behavior in financial markets. Support is the price level where buying interest tends to outweigh selling, causing the price to bounce upward, and vice versa. Resistance is the level where selling outweighs buying, causing the price to recoil downward. Let's take a look at the real example on the US dollar to Canadian dollar chart. We can mark these condition points as the support level and this as a resistance level. These levels form as a result of the trader's memory and expectations. For example, when the price falls to a previous low, support, traders may see it as a buying opportunity. When the price rises to a previous high, resistance, traders may fear a reversal and begin to sell. Many traders and analysts monitor the same levels. Their actions tend to confirm those levels. When enough participants believe a level is important, even if this level has never been reached before, their coordinated behavior causes the market to react accordingly. This also makes support and resistance self-reinforcing over time. The $200 mark served as a formidable resistance point for Apple, primarily because it represented a significant psychological threshold for investors. Such round numbers often act as barriers due to the clustering of sell orders and profit-taking activities. Additionally, technical indicators, such as the Relative Strength Index, signaled weak momentum during attempts to breach this level. As we can see at points near the highs, it started declining several bars in advance. Order clustering is one of the reasons why support and resistance work. Traders often place large numbers of stop-loss take profits on market orders around these levels. Buy orders around the essential support level trigger a rebound, as we can see on the weekly chart of BASF. Every time it enters the $37 to $42 range, it creates a strong reaction, causing a bounce back into the trading zone. On the other hand, sell orders around the resistance trigger a pullback. For example, in the Mercedes, the $80 level hasn't been broken in the last 20 years, and it serves as a major resistance, causing bulls to take profits and prompting bears to open short positions. When the resistance level is broken, it may become a new support. This is due to a role reversal in trader behavior. Sellers cover their short positions, and buyers continue to buy because of their greed, and vice versa, the same applies to support. On the example of Swiss franc to US dollar, at first we see as price enters the resistance level and a strong reaction follows. Then it enters the consolidation and falls down to the previous trading zone before the breakout. Afterwards, this level starts serving as a support, which we can see over here. This happens because previous sellers at resistance may turn into buyers when price exceeds this level, thinking it signals trends. Let's briefly summarize. Support and resistance are key price levels in financial markets, where buying or selling pressure tends to dominate, influencing price direction. These levels are formed based on collective trader behavior, expectations, and psychological tendencies. They are reinforced by order clustering. Also, support and resistance can switch roles after a breakout, a phenomenon known as the change of polarity.
No level can hold forever. Let's discuss breakouts.
First, let's take a look at gold. After breaking the essential $2,100 resistance level, there were no further levels, making the path towards new heights straightforward for gold. But how could we know that it wasn't a fake out? Let's take a closer look at daily chart. We see that at this point, price is higher than the resistance line and immediately falls. But at next point, here, price gradually rises, creating a breakout. And after the price didn't fall lower, here, we can say that now it serves as a support and confidently open a long position with a stop right below.
Even though fakeouts usually take not more than several bars, some can be continuous.
If we look at the chart of US dollar to the Japanese yen, there is a clear breakout, but based on other indicators, such as volume, it was possible to guess that it's a fake out. The volume is much less than usual, so the traders weren't confident in the rally, and after returning to the trading zone, the ticket steeply fell. And yet, when we look at monthly chart, We see that this level has served as the resistance back in the 80s. However, I wouldn't recommend relying only on all resistance and support points. Getting a confirmation based on technical indicators makes the probability of a fakeout much higher. Let's make a brief division. Breakouts form gradually and confirmed by technical indicators. Fakeouts are fast and not confirmed by technical indicators.
But guys, remember, the market is irrational and every rule may not work. Thanks for your attention. Write down a comment suggesting what should I make next video about. Like and subscribe. See you in the next one. Goodbye.